Time now for an in-depth look at the market news on this Monday, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good afternoon. Thanks for coming on today.
Happy to be here.
Well, let's start with the inflation situation in the United States. A number of prominent economists at this year's meeting of the American Economic Association said they think the Fed is way behind in trying to contain inflation and that it's not going to come down that much this year. What's your view on inflation this year?
Okay, well, the AEA meeting, the biggest issue in macroeconomics was inflation, and there seems to be convergence by the academic researchers that inflation is becoming a dangerous problem for not only the United States, but the global economy. The latest U.S. inflation figures, that's from November on a 12-month basis, was 6.8%. Last year, Lawrence Summers, former head economist of the World Bank, former Treasury Secretary, and former head of Harvard University, as well as a very respected academic economist, threw the gauntlet last year by warning that there will be high inflation because of the very loose monetary policy that U.S. has had in place for the last couple of years. And this will be worsened if Biden administration's government spending plans were to pass. At the beginning, this was a very controversial point of view because inflation had not risen by that much yet. But toward the end of the year, the inflation became higher and higher and even longer than expected. And now it seems that academia is coming around to Lawrence Summers' view. But with notable exception, the academics do seem to recognize now that the Fed must put the brakes on the economy. There is some question on whether the Fed is too late or whether they should, whether they are not too late to start raising the interest rate and begin and taper. But the question remains on how much monetary policy will reduce the inflationary pressure. Much of the controversy lies in how much of the inflation is due to factors in the real economy and how much is due to very high money supply. When we say real economy, it means things like the transportation bottlenecks, supply bottlenecks caused by the corona pandemic, and there is a question on whether the inflation may go back to normal levels after the pandemic is over, or whether it will remain on a higher than normal level. But both sides do agree that the longer the inflation lasts and higher the rates go, the more likely that the rates will go even higher and the inflation will be longer because more people will have expectations of longer inflation, and that may lead to wage price spiral that we saw in 1970s. So there is beginning of some fear on whether that inflationary expectations by people will rise. Some of the more interesting quotes that were made during the AEA meeting included people like John Taylor, who's responsible for the Taylor rule, that the Fed policy, he stated that the Fed policy rate should be at 2% already rather than the 0% it is currently. And even with low inflation, it should be 3% by the end of the year. Jason Furman of Harvard University said that the PCE inflation is likely to be 3 to 4% throughout the year. And John Steinson of Berkeley has said that the policy rate should be raised to 2.5% by the end of the year. And then several economists have mentioned that reducing inflation through raising interest rates is necessary, but it's also going to be very tricky because right now the United States, as well as globally, people have higher debt loads as well as higher government debt loads. And higher asset prices, overpriced stock markets, overpriced Bitcoin markets, and so on. So as the interest rate rises, interest rate burden on individuals, corporations, and government is going to rise, which is going to make policy making more difficult. And this applies not only to the United States, but also developing countries. That was emphasized by Emi Nakamura of UC Berkeley and Carmen Reinhardt of the World Bank. And then N. Gregory Mankiw of Harvard said that current way of measuring consumer price index may not capture inflation fully, so inflation may be worse than the numbers indicate. And then Glenn Hubbard of Columbia University said that quantitative tightening, selling of the bonds which are sold by the Fed, it hasn't gone to that stage yet, but it'll have to go there eventually. Selling $350 billion worth of bonds held by the Fed will be equivalent to about 0.25% point rise in policy rate. And during the pandemic, the Fed's balance sheet grew from $4.2 trillion to $8.8 trillion. So if the Fed sells all of that, all of those bonds that it bought during the pandemic, it'll be equivalent to raising the interest rate by 3.25 percentage points. And pre-corona interest rate was only 1.75%, the policy rate. So we do have a lot of concerns about inflation, a lot of concerns about interest rate increases, because we never had this type of pandemic, we never had this type of very loose monetary policy before. There is a lot of questions, and that is, in some sense, very worrying and concerning.
It does sound like we could be in for a bumpy ride. Those issues very much in focus in the equity markets, Professor. Last week, stocks on Wall Street were down, especially tech shares on the Nasdaq, off by 4.5% or so for the week. Rising rates, they're obviously a main concern. What are we looking at in the global markets as we start a new week?
Okay, for the U.S. market, the Dow and S&P dropped from Wednesday after the Fed minutes were published, and the minutes said that the Fed may be more hawkish than expected. In the minutes, there was strong support for accelerating tapering and hints that interest rates in the United States may rise as early as March. Nasdaq actually started its fall earlier from Monday, and that may be because the Nasdaq is undergoing a price correction. If you look at the December 31st closing figures compared to the pre-corona, pre-pandemic highs, Nasdaq was 59% above that pre-pandemic highs, much higher than Dow and S&P, so Nasdaq may be undergoing a big correction right now. For the week, S&P dropped by 1.8%, Dow dropped by 0.29%, and Nasdaq by minus 4.5%. Nasdaq had the worst week since February of 2021. Another interesting factor is that Bitcoin has been dropping considerably since last November, and the fall accelerated from January 4th when the Fed's minutes were published. And the interesting thing is, there's two point of view about what Bitcoin can do. One is that it can act as an inflation hedge. The other point of view is that right now the current relatively high price of Bitcoin was due to very loose monetary policy, very high liquidity, and price will fall when the Fed starts to tighten monetary policy. Right now, it does seem like the Bitcoin is not very well suited for an inflation hedge because the price is falling, and the high price that we've seen in the Bitcoin in the past is more due to excess money supply than demand for stable assets that's not affected by the central bank. Europe, it was rising until the 5th, as in the United States, then it started falling after the Fed minutes released, but TAC and DAX continued to fall today while FTSE was rising. Asia, Nikkei followed the U.S. path, falling from the 5th. Shanghai also followed the U.S. path from the beginning, but it rose today. And Hang Seng is actually acting just the opposite. It's actually rising since we heard the tightening news from the Fed. That's probably because the Chinese government announced that they will do something about their real estate sector.
Well, here in Korea, stocks are also widely expected to see volatility in the near term, and that was the case today. The Kospi down about 1%, the Kosdaq about 1.5%, with this anxiety about monetary tightening in the U.S. Tell us about the domestic market and where you see it moving.
Okay, well, Kospi was down most of last week. It went down more than 1% on Wednesday and Thursday. It did gain a bit more than 1% on Friday, but still, overall, it was a down week, and it was down today as well. It was down 0.95% today. Individual spot, institutions and foreigners sold. And Bank of Korea is expected to raise the interest rate by 0.25 percentage points when they have their meeting on January 14th. So that probably had some effect on the lower prices in the Kospi as well. Kosdaq, similar story, except with a larger degree. It was down last week. It was down more than 2% on Wednesday and Thursday, but it did gain 1.5 percentage point on Friday, but still, it's following the U.S. trend by heading downward for most of the week. And today it fell by 1.49%. Individual spot today, and institutions and foreigners sold.
All right, Professor, we'll have to leave it there for today. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you.